I did want to discuss you shorting the stock market for the first time since 2008.
You don't have enough time to go over everything for the bearish reasons why. That's how negative overall it is for me. I do think over the next several weeks, we will see not only a huge top put in, but the chances of a very sharp decline.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for May 25th through June 1st, 2026, while supplies last. First this week, pre-1933 $20 gold Liberty or gold St. Gaudens coins in an MS62 grade are just $150 over melt per coin. Kilo silver Valcambi bars are just $4.15 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is our good friend Peter Grandich from Peter Grandich Company. Thank you so much for joining us today, Peter.
Always a pleasure, my friend.
Well, it's great to have you today. I did want to discuss you shorting the stock market for the first time since 2008. Now, if our viewers have been following you for long enough, they'll know that you have, you're famous for calling the 2008 crash, the 2000 crash, and also back in 1987 on Good Morning America, calling the Black Monday stock crash and then the subsequent recovery. So I did want to ask you about what's going on right now. It seems like the stock market is at all-time highs. The tech sector is booming, but you're actually shorting the market, and the first time you've done that since 2008.
Okay, so as you know, in 2001, I made a dramatic change. I felt that gold would actually outperform general equities and bonds. And in our planning group, and we're going to push towards $2 billion, that it's not a small group, people were just not prepared to take such an action. One client, and we have well over 1,000 clients, one listened impeccably, but it was unheard of to think of that. But that was a key change in my thinking. And from that point on, I was not an equity bull. This is not like I was a roaring bull and suddenly I think there's a top. I don't want to get credit for that. What I will say is that I chose other things that have outperformed the general equity since then, which is the most important thing at the end of the day. However, because I feel that this is the top of all tops, there's so much more challenges here and negatives than in those three previous that you spoke about. I felt it was time that it was worth speculating. And remember, the word speculating is used so we don't say gambling, but they're both the same thing. For my personal self, and last Friday, took short positions, not thinking I got the ultimate top, and said that we could even rally into this week, which obviously now with this news over the weekend, again, chances are we're going to open up tomorrow, Tuesday, higher in the stock market, and to be prepared to add to my positions. And you don't have enough time, and I'm being serious, Elijah, I'm not being sarcastic, to go over everything for the bearish reasons why. That's how negative overall it is for me. It doesn't mean it's going to happen right now. It just means that it's getting to that point. And as long as I don't go too crazy and send everything in on the first and only bet, I do think over the next several weeks, we will see not only a huge top put in, but the chances of a very sharp decline. Now, I don't believe it's going to be a crash because 87 was a crash. When you're down 20-something% in a day, that's a crash. But I do think we'll lose at least that much, if not more, over time.
Why do you think the economy feels stronger than it really is in this case? Because it seems like, everyone is betting on the stock market going higher at the moment, but you're betting on it going lower, or at least in the near future. So what do you think is giving people a false sense of security?
That's a good question, Eli. So I'm going to ask you to participate in it. If you didn't look at the stock market now, if you can just take the stock market performance out of your mind and look at everything else you know about the economy, employment, consumer sentiment, costs, Just the people you spoke to in the last 2 to 3 weeks, a variety of people, professional, retail people, individual workers in the street, would they have a bullish, bearish, or at least a cautious view? I'll argue that they would have at least a cautious, if not a bearish view. And that's what's really interesting. The 10% wealthiest Americans own almost 85% of the general equity market. So a smaller group at the top echelon have benefited from the stock market performance. Unfortunately, the vast majority of Americans are dealing with higher expenses, higher inflation, no wage benefits, and now concerns in a matter of a few years, many of them will be out of a job because AI is going to replace them. And if it's not AI, it's a robot. So it all depends on who you speak to and what you speak about. And I'm just in the camp that believe that the stock market can't forever keep itself separate from the reality and the pull down that it's going to get from all the other bearish factors in the economy.
It does seem like there are a lot of bearish factors. It is just so interesting how it seems like the market is not acknowledging this, but it does seem like at the same time that we are getting maybe some breadcrumbs here and there or some indications that the smart money is starting to move out and starting to go into cash, like Warren Buffett, for example. What are some specific instances of other people who are, I guess you would say, or are thinking the same way that you are right now?
Well, let me give you the example that I used about a week or so ago to my clients. And it involves a very popular game in the casino. And if people don't know it, I'll get the simplest way so they can understand why I use it as point of view. It's a game called craps. And basically the way the game is, most people at the game bet on the shooter. And the way the game starts is they throw out the dice. And if you bet on the shooter, if a 7 or 11 comes out, you win. If a 2, 3, 12 comes out, you lose. Or any of the other numbers, 4, 5, 6, 8, 9, and 10, that is what's called your point. And in order to win your bet, you now got to make that point before a 7 is thrown. That's the simplistic part of the game of craps. Every once in a while, not often enough to make you want to go and play, but every once in a while, if you've been in a casino long enough or if you played the game long enough, suddenly someone that's throwing those dice keeps making points and numbers. Minutes pass, 10 minutes, 20 minutes. Normally, most of those games are over in a couple minutes and a new one starts and so forth. And what happens at that table is my description of what's happening in the stock market right now. Almost all those people betting on the shooter get so much more excited than normal. They make bets that they would normally not make bets if this wasn't happening. And they all think a 7 has somehow disappeared from the dice. But inevitably, it comes. And that's what bubbles do, Elijah. I lived through 3 of them. 87 wasn't a big bubble. It was just a minor bubble compared to the internet bubble in 2000 and the mortgage crisis. But now we have such a separation of the stock market and what people are betting on here and what the stock market used to be about. It's not anymore. Now, I'd like to explain that to you. It used to be a place where people simply bought part ownerships of businesses and sold them, and businesses depended on the economy. When I started in the business, Elijah, in 1984, 90% of the trading was individuals, and that's what they were buying it for. It was only 10% institutional. There was no computer trading at all. Now we're saying it could be up to 60% of all the money in the stock market. All of it is in passive investments. This is where money's flowing into certain types of indexes and ETFs and all that are there just to track a particular index. And the most popular one is the S&P 500. The manager, he or she, has no discretion to hold back or buy different stocks. Its job is to take that money and buy the stocks that match the performance so that ETF can match that performance of the S&P 500. in a way, to me, it's kind of like a Ponzi scheme because the money automatically comes in and it has to be put to work and it kind of feeds on itself. And that remaining 40% or so, 2/3 of that is algorithm trading now. Trump has mastered it during this Middle East crisis, timing his comments about the markets and Middle East potentially peace now for 3 months in order to kick those algorithm programs in where the computer doesn't know emotional stuff. It's trained that if there's certain headlines and words to buy and if it's negative to sell, and that feeds on itself too. The smallest part of the U.S. stock market now is individuals buying and institutions buying and selling stocks to be part ownerships of businesses. So the economy and the performance of the economy doesn't have the same ramifications on the overall stock market that it did 30 or 40 years ago. And one of the reasons I like to point this out, Elijah, because if you have gray hair or no hair, or if you're people of my age, boomers, you can trade the market or look at it the way you did in the 70s, 80s, and even 90s, because the board game has completely changed. That's another reason why this bubble has been able to grow exponentially and so much in more of a narrow group and a narrow thinking mind. And here's the other thing, and this is what gets me some negative emails from my so-called peers. We have an entire generation, no disrespect to your youth, but we have an entire generation of professional advisors and investors who have grown up on a market that simply goes one way up. And if for any reason there's a decline, markets are manipulated by the Fed, whoever it may be, in order to turn that around or, in a sense, put the car back on the road, step on the pedal, and go forward. And that's all they know. And you can't blame those folks. Don't get me wrong. They're not doing anything dishonest at all, but that's what they're used to. And it's going to take something dramatic too, and that would have to be a bubble when there's such a big loss across a broad spectrum and a lot of people suffer from it, for people to wake up and then see all the things that you and I could discuss separate from the stock market that are very, very bearish, including, if I may point this out, I know I'm running on here. If you remember, one thing you and I talked about last year a lot, and I said Trump was making a fatal mistake on the trade front. I said he took a big stick into something he should have took an olive branch, and two things were going to happen. The tariffs would be reversed. Remember, they were being sold as this great reason that's going to push the economy and all. And two, it was going to alienate our allies. Rightfully or wrong, whether they were screwing us, as he tried to imply they were for years, and he was giving it back to them, alienating them in this regard was going to hurt us on the world stage. And I believe the Middle East and what recently happened in the trip to China is clear proof that that's exactly what happened. So there are a lot of bearish things that once the bubble breaks, I don't know from what level, I feel now at least it's getting close, and that's why I'm taking these positions. When you take that away, there are so many negatives now that when we do have the break, we're going to have quite a long-time bear market. It's not going to be a matter of months, and it may not be just a year or two. It could be for several years.
It is quite a fascinating change of, how the markets operate that you've really described. I remember there was a meme you shared on your website. It was, trading the 80s. It was all about, it showed a guy and it was all about the technicals and the fundamentals. And then trading in modern day, it's all about tweets and what Trump is saying. And we've really seen that over the last couple months during the Iran war, just the oil price whipsawing back and forth and markets just whipsawing, and this huge rally we've seen just based off of, tweets that the Trump administration might be putting out, or just some, as you mentioned, maybe the headlines saying, oh, the war's coming to end. Oh, actually it's not, so we're just seeing this crazy market. How do people, step back and look at the technicals, look at the fundamentals as you're doing, and not get really pulled in by their emotions or just seeing the stock market going back and forth there?
Well, I don't normally trade. So this is like I said, I haven't done something like this since 2008. But I do think you make a very good point. Well, the first thing is that there's a great book. It's been out for decades. It's called The Intelligent Investor. It's always a book that I tell people who are learning and want to understand. Those things didn't go away. It might seem that way, but at the end of the day, inevitably, the stock market will return to fundamentals. And the fundamentals are always interest rates, inflation, earnings, growth, things of that nature. When you take away just the actual performance and you look at all those, the only other positive that you can make is there has been, in a narrow group, significant earnings, but it's been with trickery. And what I mean by that is Wall Street got very smart in recent years. Analysts, this is my interpretation, there's no set rule in this. This is me looking at it, and there'll probably be some others that may agree. They've lowered their bar on their earnings estimate so they can create what they like to call, beats. In fact, one of the financial networks spends 5 days a week when markets are trading, after the market closes, going through reports on earnings. Did they beat? And they come in and all. And so they created a feeling that things are doing better than they really are. Analysts, and I've talked to the few that I have known for years, who've tried not to fall into that trap but been pressured into it in order to interpret as if things are much, much better than they are. But when you start seeing companies like Walmart, which is, it's Walmart, it's almost like a supermarket. It's not big profit margins and all that, and start trading at multiples 2 to 3 times higher than normal multiples, and start making up reasons, let alone when we're looking at things that are trading at 300 times PE, 200 times revenue sales, 30 times book value. That's all tossed aside. That's why Warren Buffett, who you talked about how do people handle it, that's why he's been a net seller. He's stuck to that belief that things will still be like they used to be. It's not different this time. It may have came about somewhat different, but the end result is not going to be different. And that's the camp that I'm in. And that's why I was willing to, at this point in time, say to myself, enough is enough. This is an area now where I should at least attempt to profit from a potential, bubble bursting.
I think that's fundamentally what a lot of our conversations on the channel, what a lot of the guests reiterate, is that at the end, the fundamentals do play out. Mother Nature wins in a sense. And the whole idea of owning gold and silver is that thesis that right now we're in peak lunacy, right? When governments are printing all this currency that isn't backed by anything, people have forgotten that gold and silver are money, but they're slowly realizing that. So in the same way that people are going to rush towards precious metals and already are in some way, they're going to learn that, PE ratios of 300 are absolutely insane.
Gold's a good leadway in this. So think about when we first got to 4,500 in gold. Man, everybody was excited. In fact, we were starting this parabolic rise. And of course, I exited when we got over 5. But everywhere you turned, people were bullish. Now, many of those same people at 4,500, 6 months later, at best, are just dire. It's all over. You think gold was 1,200, and that's psyche. And that's the other thing that you have to understand about the stock market. The psyche of the market now, it's that craps game where 7 has been taken away out of the dice. We can't miss. You had to be in those type of feelings when they're going on. That's where the stock market is now. And that little bit that lasted in gold at the beginning of the year, because we did have a psyche. That's why we had the parabolic in gold and silver. We had rocket ships every 4 posts that you looked on the internet is silver going to the moon and all. Virtually all gone again. Sentiment numbers have returned almost back to, oh man, I'm never going to make money in gold and silver, these type of conversations. And you have to put sentiment factors into your decision-making on things. And when most people, people don't like hearing this, and it's going to sound like a little bit of an ego for me, but most people don't succeed. Most people only do well in the middle. But they tend to not get in early enough, and they stay too late in something. And that's why you have to use sentiment indicators to have judgments and all. And the sentiment indicator in the stock market is off the charts. And in gold and silver now, it's back to reasonable levels where whatever corrective phase that we've gone through, much of it is behind us. It's behind us in silver, by the way. I still think gold needs to do a little work.
I think it's really important to keep a level head in all of this. And I did want to touch, I guess, a little bit more on the psychological side of really investing during these times, because we can, the mainstream media can be pushing one narrative when we have to stick to our guns, right? And as you mentioned, shorting the market right now, which to a lot of people seems insane, but we need to, have emotional discipline in these times. So do you have any more thoughts on that?
Well, first of all, it's a small percentage of my overall portfolio. I certainly wouldn't tell anybody. Shorting is not something normally most people should do to begin with, and most people can't do. And here's the number reason why most people can't do it. You could only make a definitive amount of money shorting. 99.9%. If I short something at 100 and I buy it back at a penny, I made 99.99 on my money. Theoretically, I can never say that a penny stock can't go to 100. Second of all, for a lot of Americans here on Memorial Day and all, it's un-American. Who wants to root for something to go bad? Who wants to have, something terrible happen in order for me to profit and all? But there is reasons to at least, if not think of shorting, think when markets become too overpriced, and do you own too much of that particular investments? And here's the thing. I don't know if I've ever gotten to share this with you. So years and years and years ago, I was on a show before there were known many crazy shows. It was called the Morton Downey Jr. Show. And at the time, it was one of the first crazy talk shows. And it was the 1-year anniversary of the 87 crash. And they brought me on because here was this kid that didn't even graduate high school, was in the business only 3 years, somehow called this crash in 87, and the next day said everything was going to be all right. And they invited all sorts of known people from Wall Street to come on, in a sense, to be attacked because you guys didn't do what this high school dropout kid did. And only one guy agreed to come on. He's long since gone and became friends afterwards. Actually came a bit of a mentor to me named Lou Ehrenkrantz. And they brought him on. The whole thing, we were supposed to go at it, and we didn't. But he taught me something after that show that has stick with me and has been a golden rule of mine. And I don't get to share it often. And I think it's a good time to bring it up based on what you've been asking me about. He said, Pete, you have to start thinking about selling what you own if you can't first buy it today, especially if somebody gives you a bag of money that wasn't even yours and said you could either buy what you own now or sell what you have and keep the bag of money as free money. And that's how many times you have to make a decision. Could I first go into the U.S. stock market? Could I start first buying AI stocks now? Could I first start buying stocks now? Or would I feel better, my chances of at least preserving what I have and not maybe losing as much, if not make money, by buying gold? See, that's what's hard for people to do, because either you find people that focus in stocks and avoid gold, or you find gold people that are never in the stock market. But there are going to be times when some may be better choice than the other. And that's where we're at. And so the psyche now is, if you go into any financial service firm in any part of the country and all, you'll find that 99 out of 100 clients, most of their assets are in financial assets, and there's almost no exposure to gold or silver or anything related to it and all. And that just simply tells me that the advantageous most likelihood is to do what most people aren't doing. And that's why it's another reason why I don't think the bull market for gold and silver has come remotely close to coming to an end, because we don't see any really wide-scale participation. other than for the few weeks when we went parabolic and all the momentum players came in. They got crushed and they're gone. And now we're back to, and I don't know if you hear it from, your business, but the typical people crying, why isn't gold going up? That type of mood to me always tells me, as much as it's hard for some people to swallow, we're not at anywhere near the end of the bull market in the metals, but we're seeing the psychological stuff that you see when moves are ending now, in this case, the stock market.
Last time we had you on, we did touch on you mentioned how we likely had seen the bottom in metals. Is that still your view? Because I know when we see these kind of liquidity events, we often see a sharp decline in metals as well.
So when we last talked, I talked to you about 4,400 as I thought would be the bottom in gold, which so far it's been. What's been quite interesting and learning phase for me, even after 42 years in the business, and that's the continuously being more positive on silver than gold, but it's deserving so. It is clearly trading better than gold. It has as good a fundamental argument at this point in time, and it's leading gold at this point in time. Gold still needs, in my opinion, 2 closes above 4,800 to reverse everything. But one of the reasons why 4,400 is also a good area now is that's where the 200-day moving average is now. I don't think gold's going to violate the 200-day moving average. Let's remember this. People have a short memory, even some of you, because I know a lot of your readers are very much into the metals and all. When gold last touched 200-day moving average was in 2023, when gold was just around 2,100, 2,200. After it touched it, it went up almost 150% in 14 months or something of that nature. So we're close to that bottom phase. It's still tied, unfortunately, to what's happening in the Middle East stock market. When we get hit, people say, oh, gold's going to go down because people selling it, they need money, all this other stuff and all. And then when it looks like, the war is coming to an end, like we see today, even though the U.S. markets are closed, gold and silver had strong overseas markets and all. We're extremely close to the bottom in gold. And to me, the bottom is already in silver. And the metal, I told you that when we started talking a few years ago, I said it was the safest of the three that was not going to have any hard correction. It was just going to be the turtle going up, is copper. I mean, copper's $6.40, $6.50. These are numbers that 12, 18 months ago, people couldn't imagine. And so even with much of North America investment communities, especially the U.S., not having any real exposure yet to the metals and all, these metals are all doing well. There's nothing wrong. No major is going to complain about a $4,500 gold price, especially now. Here's something that a footnote to keep in mind for a bullish factor in gold. Just last spring, mining analysts, the mining community, they like to use what they consider an average cost what a major will have in terms of what it is to produce an ounce of gold. It was around $2,200. In about a year, they're now using $3,300, $3,400. They think that's a better fair average for gold now. I've never seen the average go up 50% or wherever it was from in a year. So there is a stronger tone to the metals. It may not be everybody sees it because remember, the financial networks are never, ever going to speak on a regular basis positive about gold and silver. It's kryptonite to them. It flies in the face what they make their living all day, selling financial assets and all. And so the very fact that undertones the industry itself, all the things we're seeing on shortages, inabilities to get a whole bunch of different metals now that we need in such desperation, the corrective phase that was necessary for gold to go through, it's finishing it up. I think silver's already done it. I think copper is just has its own dynamics. And I just think that we have less chance. I think our job as financial advisors is the first job is not to lose money. First is trying to make a lot of money. And I think there's far less of a chance now if someone bought an ounce of gold that they would lose a large percentage of their money. But I think that's possible now in things like AI and these stocks and all these other type of things that have gone up 100, 200%, in a year or less.
Well, it always is a pleasure speaking to you, Peter, and quite interesting to hear your insights, especially where we are in the stock market right now and what you are anticipating moving forward. If people are interested in learning more, they can go to petergrandich.com, which is your financial planning website. And you actually also take a faith-based approach, which I really appreciate as well. Can you tell us a bit about that?
Well, you always give me that blessing, and I appreciate it. Yeah. For well over 25 years now, my Catholic Christian faith has been worn on my sleeve. It has a lot of positives. It has a few negatives as well. But my work in the planning is from a foundation of my Catholic Christian faith. Most of my commenting on markets can be found on my X page. That's the best place to go. It's what I use the most, and quite frankly, is this one of the greatest gifts of the new technology world. Compared to when I think about when we wrote a newsletter, Elijah, we would type it up, deliver it to the printer. He'd have to typeset it, print it, wait for it to dry, fold, go back and stuff it in the envelopes, mail it out, and 2-3 days later, our clients would learn about what we're thinking. Now in front of a keyboard in a matter of seconds, the whole world can know what you're thinking. In that one aspect, I do appreciate technology.
Well, Peter, once again, thank you so much for your time today. Have a great day. God bless, and happy Memorial Day.
God bless you, my friend.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for May 25th through June 1st, 2026, while supplies last. First this week, pre-1933 $20 gold Liberty or gold St. Gaudens coins in an MS62 grade are just $150 over melt per coin. Kilo silver Valcambi bars are just $4.15 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.